In England were getting rich overnight, buying shares in a company tied to South American trade and unimaginable riches. Except, almost none of that trade was real. This was a company selling the dream of gold and silver from the New World while doing almost no real business there. And yet, people were turning 100 euros into 1,000 in months, and then losing everything. This is the story of the South Sea bubble, and how it began not initially with greed, but with war, debt, and one of the most creative financial engineering schemes that's ever been attempted. If you think bubbles are a modern invention, they're certainly not. The same playbook has been running for over 300 years. If you like what you're hearing and want to learn more about the South Sea bubble, please like and subscribe. New episodes drop every Thursday at 6 p.m., brought to you by the Saucetown Investor. So let's start with the real problem that sparked all of this. In the early 1700s, England had been fighting expensive wars, especially the War of the Spanish Succession. This is a pattern we see throughout history. Wars are destructive from a human life aspect, of course, but they're also deeply economically destructive. They cost a ton of money. They cause countries to run up a lot of debt. So in the case of the War of Spanish Succession, the war started in 1701 after Charles II of Spain died without an heir. And at the time, Spain wasn't just a country. It controlled a massive global empire, including huge parts of, importantly, South America, but also Italy and the modern-day Netherlands. So whoever inherited Spain would control enormous wealth and power. And so this was not the Spain that you think of today that's a really fun place to go and vacation, but certainly no one considers to be an economic or trade powerhouse. But back at this time, 300 years ago, this was an empire. I mean, Spain controlled a lot of global trade, and like we said, importantly, trade in South America. So Charles II passes away. He has no heir, and two different families claim the throne. The first one is the Bourbons of France, and the second one is the Habsburgs of Austria. And the thought was that if France gained Spain, it would dominate Europe. If you follow history, particularly, not as much in modern day, it's more of kind of a petty rivalry, but through history, hundreds of years going back, England and France hate each other. They're constantly at war with each other. The Napoleonic Wars would come around late in the 17th century, early 18th century. But this goes back all the way, like we said, to 1701 and even long before that. So the idea, again, is if France gains control of Spain, they become the dominant force in Europe. And England could not allow that. So they joined a coalition to stop it. And again, England isn't trying to take control of Spain itself. They just don't want France to have it. And again, it's the Bourbons of France and the Habsburgs of Austria are both laying claim to this vacated throne. So this war breaks out, and it lasts 13 years. And it was fought all over the place, across Spain, of course, but also in France, Germany, Italy, the Netherlands, and even some of the colonial territories. So this wasn't a localized conflict, it was a global war. In the context of the 1700s, this is almost like a world war, just like World War I or World War II, because for most, at least when it comes to Europeans, most of the world exists in this bubble. Yes, people go to South America, North America, Asia, but as far as the powers of the globe, they are all located in this space, and there is war across much of continental Europe. So this war rages on for 13 years, and England and its allies eventually forced a compromise. And here's what happened. A Bourbon of France took the Spanish throne, but Spain and France could never unite. So Spain remained independent, and the balance of power in Europe was preserved. France almost gets like this, it's kind of a symbolic throne, right? A Bourbon is technically sitting on the Spanish throne, but they cannot unite France and Spain and create this superpower that could potentially dominate Europe and dominate the globe for that matter. So the war ends, but the victory came at a massive cost, like we talked about earlier, economic and in human lives. If you're interested in investing alongside us or just want to learn how we think about deals, you can head to our website, saucetownproperties.net, where we share current, past, and future opportunities for people who want to invest passively alongside the Saucetown investor. If you're not ready for that, you can check us out at our Substack, also called the Saucetown Investor, or you can follow Matthew Cox on LinkedIn or on Instagram. England financed the war almost entirely through borrowing. Sound familiar? This is another theme throughout history. It's almost always impossible for a country to raise taxes in order to finance a war. So if you can't raise taxes because that's politically untenable, what do? You go into more debt, you borrow. And so by 1710, the British government had accumulated roughly 50 million in national debt. And that number may not mean much on its own. It doesn't sound like a ton of money in 2026. So let's put it in context, because there's NBA players that make 50 million bucks in a year now. But at the time, the annual government revenue in Britain was only around $5 to $6 million. So their debt was about 10 times their annual revenues. So this wasn't just a high debt. This was an untenable debt. Now, here's the next question. Who did they owe all this money to? How did they run up this debt? And what happened was the government didn't owe any one lender. It owed thousands of lenders. Wealthy merchants, aristocrats, bankers, even ordinary savers. And they had issued government bonds and annuities, which are essentially promises to pay interest every year. They had issued these in order to fund the war. And the system actually worked because England had something rare at the time, which is credibility. And we see this today with the United States. I mean, we go in to massive amounts of debt. I believe the national debt is currently at 39 trillion. And that's the reason we're able to do that. Most countries can't do that. The reason we can do it is because, at least for now, we have the credibility that we are good for the money. You know, we call the US treasuries, we call them the risk-free rate because they've never defaulted before. England at the time was, they were a superpower. So it was a similar scenario. They were backed by Parliament's ability to tax, and they were supported by institutions like the Bank of England, and lenders ultimately believed they would be repaid. No different than today, the US, when we issue treasuries, it's backed by the US government, our Federal Reserve, our military, our vast economy, and most people can't do that. But despite this credibility that the British government had, the structure was pretty messy, okay? You have thousands of creditors. And this is a time where there's no computers or easy way to organize all of this, where money is digital and can easily be moved place to place. And so you got thousands of creditors, and then you got different interest rates on these loans. You got different terms. Somebody who lended money early in the war might getting paid a totally different rate or on totally different structure than someone who loaned money later in the war, for example. There's one more critical detail here. The debt didn't trade at full value. So a $100 government bond might trade at $55 or $60. And by the way, I'm using dollars, obviously. It's the currency of the time. But why is this? Why would a $100 bond trade for $55 or $60? The reason is because the repayment wasn't guaranteed and interest payments weren't always reliable. So that credibility that the British government had that we just talked about, there's some cracks in it, okay? People are, if someone is 100% sure they're going to get repaid, a $100 bond should trade around $100. There's aspects that can move that, like if interest rates have moved, but when it's trading at 55 or 60 cents on the dollar, that's because people see risk in it. They see that there's a chance this might not get repaid. So think about what this means in reality. If you could buy $100 of government debt for $60, and then somehow convert it into something worth $100, you've just made a massive gain. That's not even regular investing. That's arbitrage, right? We buy something for $60. We can convert it to something that's worth $100. We make that $40 arbitrage in the middle. Sounds like an amazing opportunity, right? So this is where the South Sea Company comes in. The idea was fairly simple, at least on the surface. The government would transfer its debt to the South Sea Company. And in exchange, bondholders, these people that were owed money by the government, would receive shares, would receive equity in the South Sea Company. So these people, instead of holding government debt, investors now owned equity in the South Sea Company. So mechanically, it worked like this. The company took on the government's debt, that $50 million. The government then paid interest to the South Sea Company, and the company paid dividends to shareholders. Okay? All kind of goes in a circle here. Company takes on the government's debt, government pays the company, then the company pays dividends out to its shareholders. So on the surface, this looked like a trading company, right? The South Sea Company. They're exploring, they've got boats, they're going overseas, they're a trading company. But this wasn't really the business. Trade was the story, but debt conversion was the actual business. The company became valuable by absorbing government debt, issuing shares, and increasing its stock price. The higher the stock went, the easier it was to convince more creditors to convert, right? You see your friends are making all this money, they're buying shares in the South Sea Company. I want a piece of that. It's FOMO 300 years ago, just like it exists today. And the more debt that the company absorbed, the more powerful it became. This helped the government. There's a reason they did this. The government was in a tough spot. It simplified its obligations, and it even reduced borrowing costs. There's a little ambiguity here, but most estimates say in the aggregate, the thousands of people that the government had borrowed money from, they were paying in the aggregate about 8 to 9%. By consolidating the debt and moving it all over to the South Sea Company, it actually brought borrowing costs closer to 5 or 6%. Now, when you talk about a massive sum of money like that, I mean, if your mortgage even goes from 8 or 9 to 5 or 6, there's some huge savings there. So imagine that on a debt as prodigious as what the British government is dealing with. And importantly, the participation was voluntary. Nobody had to swap their bonds out. But if you're holding debt that's trading at a discount, remember, $100 bond trading at 55 or 60 bucks, and somebody offers you equity with upside, potentially at full value, this becomes very attractive. You're holding what's essentially a distressed asset that's selling at 55 or 60% of par, and you have a way to get out of that and get full value on your principal, but you also get the upside of this exciting new company that's, traveling overseas and chasing riches in South America. It looks very attractive. So let's get to the South America part. Let's talk about why people wanted these shares, because this is where the story really takes off. The South Sea Company had rights to trade with South America. Through the Treaty of Utrecht, Britain gained what was called the Asiento, the right to supply enslaved people to Spanish colonies, along with limited, and we'll find out very limited, trading access. And this mattered, okay, because South America had a reputation. For centuries, Europeans had heard about enormous wealth flowing from the New World. Places like Potosi, it's a legendary location. A silver mine was located in modern-day Bolivia, and they had staggering amounts of silver in the 1500s and 1600s. If you've read through history about like the conquistadors, Hernan Cortez, people like that, I mean, they went to South America because there were riches promised. And in fairness, there were riches there. Like this part was real. So for generations, treasure from South America had flowed into Europe. So when people heard South America, they didn't think about limited trade agreements. They thought about unlimited riches. It's in a way, there's modern parallels to, right now the hot word, of course, is AI. We throw AI on our company name and we go raise a bunch of capital. A few years ago, it might have been blockchain, or before that, it was, During the dot-com bubble, we throw .com on the back of our name, we can go raise a bunch of capital. South America was like the hot venture investment of the time 300 years ago. But here's the critical truth of what was going on here. The gold and silver story wasn't real for this company. It wasn't just exaggerated, it was effectively just a marketing scheme. Because in reality, Spain still controlled access to its colonies in South America. Remember, back to the start of our episode, we talked about why the Spanish throne and the Spanish Empire were so coveted. A huge part of it is because of this access to these colonies where the gold and silver is. Trade was tightly restricted, and permissions that you could get from the Spanish Empire were very limited. The South Sea Company did have a legitimate contract, the Asiento, which allowed them to participate in the slave trade. I, of course, could do a whole episode on the evils of slavery and everything that is wrong with this, but for purposes of understanding what's going on here, at the time, slavery was a business. Ugly, but true. So let's leave it at that. But the other thing about the slave trade was it was in many cases, aside from being deeply evil, it was not particularly profitable. So outside of that, they have this treaty that allows them to participate in the slave trade. The commercial opportunity here for the South Sea Company was actually extremely small. And at times, this is crazy, in the actual agreement, it amounted to one permitted non-slave trading ship per year. Let me say that again. One permitted non-slave trading ship per year. They could send one ship per year to South America to try to fetch these riches that they had been pitching to their investors. And that's what these people are. These debt holders that were owed money by the government, they're now investors in the South Sea Company. One ship. So that's not a global trade empire. That's not a logistics company. That's barely even a business, okay? And the directors of the company knew this. They knew exactly what was going on. They knew the limits of this treaty. They knew that the Spanish were not giving them access to these riches that they were pitching to their investors. They understood the constraints, but they also understood something else. They didn't need real trade profits right now. They needed belief. They needed a good story. So the story of gold, silver, and endless opportunity. It was pushed hard, and this is a tale as old as time. And it was pushed not because it was true, but because it sold. How many capital raisers do we see today that go, think of like a Sam Bankman-Fried. The guy can go raise just crazy amounts of capital on a totally made up fake story built around hype. They say narcissists are good capital raisers because they just don't care, okay? They're totally fine. They would separate their own grandma from her bankroll if it could fatten their pockets. At this point, this wasn't just optimism. It was a total propaganda machine, and it was criminal. So let's talk specifically about the people behind this, because this isn't just a story about structures and economies, but it's a human story, just like any economic story. Robert Harley was one of the architects of this plan. He was a senior politician, chancellor of the exchequer. Forgive me if I'm mispronouncing that, but his job was to try to stabilize government finances. He is in a tough spot with his debt that the country has following the war. And his goal I don't think his goal was to create this massive bubble. I think he wanted to solve a real fiscal problem in the form of this debt. Okay, so that is Robert Harley. Then you have John Blunt. Blunt wasn't aristocracy. He came from a merchant background. And that matters if you want to understand John Blunt, because he understood markets, incentives, and psychology in a way many politicians didn't. A common critique of politicians, and it's often a fair one, is they're really good at spending other people's money. It can often cause an effect where money to many of these politicians almost starts to feel like an abstract concept. Just, okay, spend it, tax more, borrow more. And you get these. Blunt was a businessman. And that's why I'm an advocate of business people having a say in political policy. But I digress. So Blunt comes in, he didn't sell the present, he sold the future. And guess how he did that? He leaned in to the idea of South American riches. It's an attractive proposition. These people, like we said, there's a lot of very sophisticated people that were owed money by the British government. These aren't all, it's easy in hindsight to say these people are suckers. I can't believe they fell for that. These are not dumb people. But the sales pitch was good, diabolical, probably criminal, but effective, okay? There's this investment. It has government backing. Remember, the government is paying the South Sea Company each month. And it's got rising share prices. The price just keeps going up. Why wouldn't you want a part of this? And he also understood something potentially even more important. If you want a system like this to work, you need the right people on your side. In modern day, we would call this like regulatory capture, paying off insiders, people who are in positions of power. So what did he do? He started distributing shares to insiders. And by distributing, I mean literally just giving them shares. And they were free to do whatever they wanted with them. They could immediately sell them and pocket the profits. They could do whatever they wanted. But he knew who to distribute to. He gave them to politicians, to people in power, sometimes totally for free, sometimes on very favorable terms, like he would just give it to them on credit, meaning that they didn't have to put up any cash up front. So the people who were writing the rules were the same ones who were getting rich from the rules. Again, regulatory capture is what's happening here. So who was actually buying in? At first, it was the people you would expect, okay? The government creditors, the people that were owed all this money, who loaned the government money to finance this war. But on top of that, there were other wealthy investors that got in, obviously the insiders that we mentioned. But then it expanded. Members of parliament, aristocrats, merchants, financial professionals, and eventually the broader public, or what we would call retail investors today. And this is how the madness of crowds works, right? Everybody floods in all at once when there's a mania like this, and then everybody floods out at once when there's a panic, like we covered in last season of our podcast series on the panic of 1907. People move in crowds when there's greed in the air or when there's panic in the air. Here's a key point. Many of these people weren't adding new risk. They were converting existing government debt into shares, which was already considered kind of risky debt, hence why it was trading at 55 to 60% of par. So this wasn't just speculation. This was a transformation of the entire British financial system. Tens of millions of pounds of debt were being converted into equity in this one company. Thousands of investors were involved. This wasn't a niche trade or a part of the market. For a while, this kind of was the market. We see these throughout history, but this probably sounds familiar. People borrowing money, selling assets, pooling family savings just to participate. I mean, you see it in modern day where these bubbles form and people will mortgage their house or drain their 401k or their pension to risk it all on this, this big new idea that ends up being a bubble in many cases. And one of the most famous participants was a gentleman by the name of Isaac Newton, who is one of the great scientists of all time. So Newton, he initially invested, made some money, and got out. And this is a classic thing that happens in bubbles. But then after he got out, he watched the prices keep rising, and he got back in, and he lost heavily. I think it pretty much wiped him out. But he was later quoted as saying, "I can calculate the motion of the heavens, but not the madness of men." And man, I don't know what Newton was necessarily, if he was trying to say something super profound or if it was just, frustration at losing his money. But this is so profound for my spreadsheet warriors out there, or people who think they can solve the market. And this is one of the smartest scientists who ever lived. He was making scientific breakthroughs that had never existed until Newton came around. But he cannot, as he said, calculate the madness of men. Fear and greed will always be here. People will not act rationally. And just because your spreadsheet says something doesn't mean it's going to happen when human emotions and human psychology get involved. And Mr. Newton learned this one the hard way. So now we hit the turning point. At first, people bought because it made sense. Then they bought because the price was going up. And then the system changed because now it becomes self-reinforcing. And we've seen this with so many companies. Prices rose. So the company's like, whoa, our share price is exploding. Maybe we should just make some more shares. I mean, what would you do if you were operating any sort of business? Say you're selling, I don't know, I've got a water bottle on my desk right now. You've got a water bottle company and people keep flooding into your shop and you keep raising prices. And despite prices going up, more and more people want to buy your water bottles. Well, obviously you're going to create more water bottles to meet the demand. It's no different with stock shares. So the company sees these prices just exploding upward. They're gonna take the money if the suckers want to pay it. So they issue more shares, and then those shares were used to absorb more of the debt, which then self-reinforcing, self-fulfilling prophecy. This pushes prices higher, which then attracts more buyers. This is the exact opposite of what we saw last season in the panic of 1907, when it becomes this forced selling, pushing prices down, which creates more forced selling. This is prices going up, which creates more buyers, which pushes prices higher, which creates more buyers, and keeps on going. And here's the critical piece. Again, let's get back to the actual business of the South Sea Company, because there almost is no business. The company wasn't generating real trade profits. It was generating demand. Okay, they've got a good story. They've got some skilled capital raisers, skilled and crooked capital raisers. And the higher the price went, the more the system worked. This is a classic example of a business whose core business is raising capital. If you look like some of these Bitcoin treasury companies in 2026, they're kind of saying the quiet part out loud. There's like, no, our business is raising capital to buy more Bitcoin. They're saying it out loud. But in this case, there's a story here that there's these riches off in South America, and we're going to go get all of them. And you better get in on this now, or you're going to miss out while your neighbor gets rich. And this is an age where, of course, there's limited information. Okay, most 99.999% of Europeans have never been to South America. It's just this mythical place. You're not running a Google search to see, hey, what's up with these silver and gold mines down there? What's the story? What's the P/E ratio? It's just, there's none of that. So people are so susceptible to hype, and not that they aren't today. There's more ways to create hype using social media and things like that today. So there's a hype machine. Whether it's 2026 or 1720, it just gets executed in different ways. And it's working very well right now for the South Sea Company and the British government. So at this point, nothing looks broken. The government is involved, right? They're lending credibility to this. The government's backing this thing. What could go wrong? The financial system is improving. They've kind of found a way to financially engineer their way out of this massive debt that the country was facing from the war. And people are making money, hand over fist. And on top of that, powerful insiders are aligned, which lends more credibility to it. It's, okay, Parliament's in on this. These important, wealthy merchants are in on this. Everybody, all these smart people. And there's just so many parallels to modern day. I mean, we've heard it with things like Bitcoin. Like, there's a lot of smart people working on it, or blockchain. What could go wrong? There's lots of smart people. They'll figure it out. And so because of this, everything feels legitimate. And that's what makes it the most dangerous, because every bubble starts this way. It's logical. People don't do things because they think it's stupid. They do it because they think they're being logical. They want to make money. And it's defensible, right? The government's in on it. All these sophisticated people are in on it. And it's even smart. All these people are making money. How could that not be smart? Why would I not want to make money? That's nonsensical. But then eventually, something shifts. What started as a rational solution to a government debt problem is starting to turn into something else entirely. Next episode, the mania begins, because this is where speculation takes over and everyone wants in. If you like what you're hearing and want to learn more about the South Sea bubble, please like and subscribe. New episodes drop every Thursday at 6 p.m., brought to you by the Saucetown Investor.